All right. We are here, rocking and rolling and ready to go. How you guys doing this morning? And today, if you looked out on the little marquee, the little thumbnail, I said we were going to start, introduce you to the 1, 2, 3s, the ABCs of getting started with a UBI, Universal Basic Income Portfolio. Now, I know that there's a bunch of my students who come and attend my classes, these labs for the university, this little university lab, and everybody's welcome, the whole world, because we're here on the internet. We're here on YouTube using this service to do our university lab classes. But that's okay. That's why we're going to start here. And this is the summertime. So in the summertime, we generally like to have a little bit lighter load. So we're working just 3 days a week, Tuesdays, Wednesdays, and Thursdays instead of every single day. But in the fall, we'll start back up with every single day. But right now, we're just doing the Tuesday, Wednesday, Thursday thing. Wednesdays are in the afternoon at 1 o'clock Mountain Standard Time. And then on Tuesdays and Thursdays are at 8 o'clock a.m. Mountain Standard Time. So if you're in a different time zone, you're going to need to make that adjustment for your time zone if you want to come and join us. But again, this is a lab for our university students down at Utah Tech University in Southern Utah. And everybody's welcome. And what we're going to be learning about today is I thought it'd be fun to start kind of from the basics. All right, go back to the beginning. And for many of you, this will just be a review. And it's okay to review. If you want to stick around for the review and watch some of the stuff, you can always pick up new things along the way. Some of you have already seen this presentation, and I'm going to do a little bit of a slide presentation. Don't usually do the slides, the PowerPoint slides in the YouTube classes, because being a lab, we do the PowerPoint slides, do the academic side of learning in the classroom, right, at the university. And then we come out here and we do the practical application. So we do a lot of practical application here. But today, since we haven't had classes for, it's been a couple months now, and we're going into midsummer, and we won't have classes again until this fall, I figured it'd be fun to do a academic class today. And so I pulled up some of the slides that we use in our academic class at the university, and I've got those. We're going to run through some of those very quickly just to introduce people to this new concept of universal basic income. Now, this is something that I've been teaching at the university. I taught at Utah State University for about 12 years, and I never touched this subject. And then I taught at Utah Tech University. This is going on, I think, my 11th year. So I've been there for 10 years and have only touched this subject the last year, I guess you could say. The last two, just this last 2024, 2025 school year. And now we'll be going into the 2025, 26 school year. So this is a new subject. And the reason I haven't really touched on it is because there's some new things that have changed in the markets. And I think there's a little bit of history that would be fun to talk about when it comes to these new styles of trading. And I want to kind of go back a little bit and give you a little bit of my history. And I started back in around 2000, spending time at the Chicago Board of Trade. That was kind of where I kind of made my move from just running around doing my own thing into the Chicago Board of Trade, working with those people there and those experts and those traders and some very wonderful people there. And kind of this is on my mind because I just wrote an article, just finished up an article for Pitt News Magazine. And of course, most of you here know Pitt News Magazine. You know that Pitt News Magazine is the club magazine, and it's the magazine that we use to help highlight the things that we talk about in class. So at the end of the month, we kind of summarize everything we've been talking about in class. We create articles for it, and then we put it out as a digital magazine. We record all the articles so that they're audio, and it's a lot of fun. It's a really cool magazine, and just real quick, here you go.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
It's one of my favorites. All right. So Pitt News Magazine is our club magazine. And so you can go subscribe to it. And just because you're not a student doesn't mean you can't subscribe to it. Of course you can. Anybody in the world, we have subscribers from all over the world picking up Pitt News Magazine. It's a wonderful magazine, and you can get it for $1 for the first 2 months, and then if you like it, you can keep it, pay the $39.95 for the rest of the year, or for another 12 months. So you get the first two months for $1, and then 12 more months for only $39.95. So it's like, land, why only $39.95? Other magazine subscriptions like this in the financial industry are hundreds or two hundreds of thousands of dollars, not thousands, two hundreds of dollars, $100 to $200 for an annual subscription. The reason we keep it so low is because we're not really trying to charge for it. It's supposed to be a free magazine, but we don't want all the riffraff. So if you don't charge for something, you get a whole bunch of people from lots of weird foreign countries coming and subscribing to your magazine. So weird foreign countries, you're welcome. Come and subscribe too, but you have to pay $39. You're not going to get it for free. And that little barrier helps keep our subscription services with people who are serious about wanting to do this. And that's who we want in our magazine. We don't just want a whole bunch of freebie seekers out there just trying to figure out, just, oh, well, it's free, let's take it. And then they never look at it, and they're really not part of our community. So we just really want community people. That's why it's only $39 a year. All right. So, but it's really, in my opinion, well worth way more than that, because we do record all the articles, and all the articles are there for you. So that's something that we like to encourage people to go and do, and it helps cover the costs of some of the things that we're doing, and it gives a really good service to you. All right. So the reason I bring that up is because I wrote an article in Pitt News Magazine a little bit about my history and where I came from and how I got here, and why I'm sitting here doing a YouTube channel or teaching at the university and not some other guy. All right. Not that there aren't other guys, there certainly are, but why this guy is doing it. All right. And so that article is going to come out in the August Pitt News Magazine. Believe it or not, we're already working on articles for Pitt News in August. Can you believe that? The July hasn't dropped yet. It drops next Monday. So you'll get the July issue, and it's really good. It's really wonderful. Very excited to get it into your hands. Every month, I'm just like, I can't believe we just did that. Really just an amazing version. And I'm just like, I don't know how we're going to top that. And then the next month comes along, and I'm just like, wow, we just did another really amazing version. So we just keep coming. We've got a good team here at Pitt News Magazine, and a lot of people working on it. And so it just, home runs every single month with new issues and lots of fun. And so I just wrote an article about my history and about the Chicago Board of Trade and the Pitts, and where the Pitt News Magazine, the name of the Pitt News Magazine comes from, and all that kind of stuff. And Claire just gave me the podcast, which is the August version of the podcast, on my article. So you can look forward to that. And it's really good. I was really happy. It was, it kind of has a little nostalgia for me, because it's my life. And that's what's being highlighted in the article, and people talking about me and stuff. It kind of feels good. I must say, it felt really, really interesting. And it was like, wow, that's really cool. I was really cool back then when I was a young man. I did some really cool things. So, it's fun to hear even just people talk about who you are. But I'm anxious to get that in your hands so you kind of understand the whole concept in the world of where this all comes from. All right. Why we got started with Track and Trade and Pitt News Magazine, and teaching at the universities, and teaching at the Board of Trade for 10 years, and all that kind of really fun stuff. And what where the pits are. We used to, it was the name of the magazine, the kind of the impetus of this was Pitt News Magazine. It's like, what's Pitt? What's the pit in Pitt News Magazine? Is that like a barbecue or something? No, back in Chicago, we used to trade in the pits. Now, I never did. I was an instructor there, teaching people how to leave the pits and go to the computers. But, they traded in the pits with their hands, and they yelled and screamed across the pits. All right. So that's why it's Pitt News, because it was the news about what was going on. And the economy in the world was the pits. I mean, it was the heartbeat of America, right? Down in those pits. That's where you traded every single thing in the world, right? All the commodities, the gold and the silver and the crude oil and pork bellies and orange juice and everything, eggs and butter. I mean, everything that you can imagine that is the core structure of our economy is traded, or was traded, by hand in those pits. And so it's, Pitt really stands for, it was kind of a play on those pits, Pitt News. So the economics of the world. So that's what Pit News is. It's a magazine for traders, right? And that's what it is. And that's where the name comes from. So it's Pit News. Pit News being the pits in Chicago at the Board of Trade and the Mercantile Exchange. All right, so that's just a little history of where this came from and how I got to decide that I want to come in here. Now, one of the reasons why I want to talk about this is because in the Chicago Board of Trade, at one point, they did single stock futures. Now, you can't trade single stocks in Chicago, right? Those are done out of New York in the New York stock exchanges. So in Chicago, we tried to do, when I was there, we tried to do the single stock futures, and they were really cool. So you could trade in Chicago, and it was electronic. I don't think they ever tried to do a pit version of it, but you could trade single stock futures on stock. So you could have Apple, Microsoft, Amazon, and you could trade a futures contract on Amazon. It was a really cool idea, and it was amazing. I mean, I just thought this was going to be the future of trading stocks, and then we couldn't get anybody to do it. We couldn't draw in, and it's a competitive world out there. All these exchanges, right? They're not government entities; they're private companies, so they're competing. And so the Chicago Mercantile Exchange, Chicago Board of Trade, they kind of thought they could pull some stock traders over into their exchanges to do these single stock futures, and they were cool. Oh, they were cool, and I loved them. And I thought it was going to be the future of what we were doing, and it died, and they had to turn them off. Nobody was interested, and so that was a very sad day for me. I was really sad when they got rid of the single stock futures, and the reason I bring that up is because over in the stock market, okay, we have something called ETFs, exchange traded funds. And exchange traded funds are a basket of stocks that some manager has decided are going to make a lot of money if you join them together, right? So like a mutual fund or like a stock fund or something, right? So you put some manager goes out and he says, hey, I think that if we grab this stock, and 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 we put it all together and put it into a fund, well, you can then invest in that one fund and it will diversify you across those different stocks. And those were at one point relatively new. They're relatively new in the financial industry too, going back a long time. They're kind of a relatively new thing, ETFs. And so you had these exchange traded funds. And then some bright fellow came along just 2 years ago and he said, remember when we were doing single stock futures over in the futures market? They were really cool, but they didn't go anywhere. But I got another idea. What if we come in and we do single stock ETFs? Single stock ETFs in the stock market, not over in the futures market. Now, wait a second. Single stock ETFs don't make sense because an ETF is an exchange traded fund, meaning that fund needs to have a bunch of stocks in it, right? And it's a basket of stocks. It wouldn't make sense to have an ETF, an exchange traded fund with only one stock in it. Why wouldn't you just go trade the one stock? Why would you put it into an ETF? So this was kind of a weird concept, all right? It's kind of like the single stock futures over in the futures market that I was so excited about. So he comes along and he says, let's do this. And his name's Jay Pestricelli, all right? So he comes along and he says, why don't we do single stock futures in an ETF? So it's a single stock ETF over in the stock market instead of the futures market. And then what we'll do, instead of trading it, you don't put your money into the ETF, the exchange traded fund, for the purpose of trading or us just going and buying shares of the underlying stock. What we're going to do is we're going to take that money and we're going to trade options on that one stock. Now, there's also, and he's bright guy, right? So he comes along and he says, we can also do an ETF with multiple stocks in it and trade options on the ETF with those multiple stocks. So he can come in and he created a basket of stocks, right? Called the Magnificent Seven. Now, there's already one out there called the Magnificent Seven. There's an ETF called the Magnificent Seven that you can go, and it's called MAGS, M-A-G-S. In fact, we can pull it up in the software. I'll just show you right here. Better to show than tell. So we're going to come in here and we'll just pull up MAGS. All right. So this is the Magnificent Seven. So what this is invested in Apple, Amazon, Netflix, Google, uh, Meta, Tesla, and one more. What is it? Not coming to my mind. So one more. Anyway, there's 7 of them. All right, it's the Magnificent Seven. And so that is what you invest in if you go into mags. So the great thing about this is if you want to buy into all those really high tech stocks, right? Most people do. They're like, oh, we all want to have kind of, that's our core tech stock version, right? And if you go and you try and buy each one of those, well, some of them are $300 a share, some are $200 a share, and you try to create your own little, portfolio with the Magnificent Seven in it. Well, that's kind of hard to manage. All right. So what you do instead is you just go buy the ETF, the Exchange Traded Fund for the Magnificent Seven, which is MAGS. And you can see it's trading at $54. So makes it very accessible to anybody to go and diversify across all the Magnificent Seven stocks, the high-tech stocks, and just put your money into MAGs instead. All right. Very easy, very simple. And then they just take your money and they just diversify it into those funds for you, and you don't have to watch anything but mags, and that's your whole portfolio. All right. Some guys, that's the only thing they trade. There's I just put it into mags because it's across Apple, Amazon, Netflix, Google, Meta, Tesla, and that one more that's eluding me. I have to go look it up again. All right. So the idea is mags, and then he came along and he said, well, what if I wanted to trade options on all of those stocks? What if I wanted to trade options? There was no systematic way for you to go and trade options on some of these stocks. Now, there have been in the past some other bright individuals who have created funds, and I'll show you a couple of them here. JEPI, JEPI, they trade options, okay? JEPI, and they also JEPQ, JEPQ. JEPQ is on the QQQ. They trade options on the QQQ. All right. So this is JP Morgan Chase, big bank, right? They trade options on the QQQ, and they trade options on JEPI, I think is the S&P. All right. So you trade on these different markets, and they're bright individuals trading options. And so, but again, QQQ is a basket of stocks of 100 stocks. JEPI goes into I think it's the S&P 500, and it goes into 500 stocks. So they're trading options, and they're basically, all they're doing is they're just doing covered calls. So they buy the underlying shares, and then they put a covered call out there, and they gives them a little bonus. All right. And then they pay a higher dividend. So if you go look at the dividends on JEPQ, for example, which better to show than tell, right? Let's jump over there. And I like this little program because it does options, or it does dividends, and that's about the only reason I use it. It's a shitty little program, but it does do dividends, whereas our trading platform, Track and Trade, does not do dividends. So we're going to come in and we're going to look at JEPQ, all right? And we'll just pull up JEPQ, and JEPQ gives you a dividend every month. So there you can see a dividend on JEPQ every month, and right there they give you 62 cents for every share you own. Now, every share is $54, and that ends up being a pretty good little fund right there. If you like this concept of trading options on these basket of funds rather than just holding the stocks themselves, and the reason you'd trade options is because you're going to get, a diversification, or you're going to get not a diversification, you're going to get a higher leverage with options, and that's why you trade options. Now, these guys aren't really trading options as much as all they're really doing is they're buying the underlying QQQ, and then they're selling covered calls to collect some premium. So if you understand covered calls, you understand what an option is. If you can buy a call, you can sell a call. If you buy a call, it costs you money, right? You pay for it, and if the market goes up, you make money, and it's a leveraged instrument. So you put in a small amount of money and have the potential to make a large amount of money. All right. The opposite of that is that if somebody buys that option, somebody has to sell it to them. All right. So there's two sides to every story. And so if somebody buys a call option thinking the market's going to rise, well, somebody has to sell them that option. Usually it's an institution, an organization. Retail traders can do it too. And more people are starting to get into selling options. Most retail traders just buy options, and then the institutions will sell the options. But you can come in and sell an option too. So if you buy the underlying shares and then sell a call option, they give you a premium. They give you the premium, the amount of money that the guy who bought the option paid. All right. So if you buy an option, you have to pay a premium for it. And that's the amount of money that you have to put down to buy that option. Well, if you sell the option, you get to keep that premium. They give you the premium. All right. So a covered call is just somebody who owns the shares and then they sell an option, collect the premium. So it ends up being like a little bonus. All right. And so that's what JEPQ does and JEPI. So they go into these basket of funds, which is the QQQ. And I can show you the QQQ in here too. QQQ is a nice little basket of funds of the NASDAQ. It's really popular to put your money in here. All right. So it's the same things like the S&P 500. You drive down the road in your car and you always hear on the radio, the S&P is up 5 points. The S&P is down 5 points. You know, it's like the backbone of the financial industry is the S&P 500. So that one is a SPY. And that's, again, it's an exchange traded fund. All right. So it's got 500 stocks in it. And people like to track this market. And this is the one that a lot of people trade. All right. So you just trade just put your money into the SPY, and that puts your money into 500 of the biggest, best stocks in the whole world. And then you don't have to think about anything else. It's managed for you. It's a managed fund. Now, yes, sometimes the stock market goes down, and that's the way the stock market works. Sometimes it goes down, and then sometimes it turns and goes back up. And if you sit through that, it's painful, yes, but over that 3-4 month period of time, you lost a whole bunch of money, and then your money came back. And over time, the S&P 500, the U.S. economy, basically the 500 biggest stocks and the U.S. economy grows over time, right? So we talk about how the U.S. economy is growing, and that's 1 or 2 or 3 or 4% per year. It's called the GDP, right? Gross domestic product. So it ties back into the S&P 500 and it grows about like that. Now, the S&P 500 is not the whole country. It's just the top 500. So it'll grow a little faster than the GDP. GDP might be 2 or 3% or 1%, depending on who's, running the country at the time. So right now it's being run by somebody who knows how to run countries, and so it's quite big. The GDP is doing quite nicely. We're pushing up into 3, 4, 5%, 6% sometimes. Amazing, right? That the country can grow that big in 1 year. So it depends on who's running the country usually, and that's why your vote matters. Not to get political or anything, but some people run the country poorly, and some people are good managers of business, and they can run the country well, and so the country grows. And if you are investing into the United States growth, which is the S&P 500 or the NASDAQ, you want the country to do well. You want these countries and these firms to do well. That makes you money, right? You get to invest in these big countries, these big companies, which are part of the United States economy. And if the economy does well, everybody makes money. And that's the whole idea. And so over time, because the economy has grown and the S&P 500, these big companies have continued to grow, people who have invested in that have done quite well over time. Generally, the S&P 500 itself averages about 10%, which is double the GDP being around 4 or 5%, if we're lucky, if we can get it up to 4 or 5%. All right. So that's what the S&P is. All right. So you can just buy the S&P, put $10,000 in there, and over a period of time, it averages about a 10% growth. That's pretty good, right? And so the QQQs is just the NASDAQ. So we go to QQQ, and the NASDAQ again is basically the same concept, only it's just the top 100, and it's focused very heavily on the tech industry. So again, Apple, Amazon, Netflix, Google, they're all going to be in here. Of course, Apple, Amazon, Netflix, and Google they're all in the S&P as well. But we focus more on tech stocks in the QQQs. The NASDAQ is very tech heavy, is what they call it. So if you just want to invest into the tech heavy industry, you don't have to go out and create a portfolio of your own. You can just buy the QQQ. You're diversified across the top 100 very best tech companies in the United States, and you're done with it. You don't have to think about it anymore. All right. So that's one way of doing it. Now, this bright individual, circling back around, right, weaving it back into the story, this bright individual came in and he said, why don't we have an ETF, an exchange traded fund, which only has one stock in it, which doesn't make sense if all you're going to do is like JEPQ, right, JEPI, Let's go to JEPQ. So JEPI comes in here, and JEPQ comes in here, and they buy a whole bunch of stocks, right, from the QQQ, and then they trade the options against it. So the idea started to be born by these companies like JP Morgan, the idea of trading options inside of an ETF. So this bright individual, Jay Petrocelli, a couple of years ago, he said, what if we did a single stock option trading ETF, an ETF, an exchange traded fund that only had one stock in it. And instead of just buying the shares and selling covered calls, what if we actively traded options on that stock with a program and he said, okay, what we're going to do, and we talked about this on Tuesday. We talked about the strategy that he decided to do, and it's called a bull call spread with a naked leg. Now, it's a little more sophisticated than that, but pretty much that's what he does. All right. It's called a synthetic long position with a covered call. And so what he's doing is he's not only just buying the shares, he's buying the shares with a call option. That's the difference. If you go into JEPQ, they're buying the shares. They actually take the money you invest into their fund, JEPQ, and they buy the QQQ shares, and then they sell a covered call. Now, this Jay Petrocelli, he come along and he says, I'm going to do the same thing, only going to do it on a single stock. I'm not going to do it on a basket of stocks. Not that he doesn't, he still does. And that's where, again, circle that back around to MAGs. He has his own MAGs. So MAGs, they buy the actual shares. He doesn't. He trades the actual shares with options. Big difference. So remember, options give you that extra leverage. All right. So if you just buy the shares, it takes a large amount of money to make a small profit. If you do it with options, because it's leveraged, it takes a small amount of money to make a large amount of money. So the idea or the concept here, Jay Petrocelli comes in, he says, we're going to make an ETF, an exchange traded fund. We're going to put a single stock in there, and we're going to trade it with options. So we can make a large amount of money with a small investment, and we can give back dividends, a monthly payment to our clients based on the trading those underlying stocks, individual stocks, not basket of stocks, but sometimes basket of stocks too. But those underlying stocks, we're going to trade them with options. So it takes less money to make more money, not more money to make less money to make more money, because we got that leverage that we're doing it with options. And he does what we call a bull call spread with a naked leg. And he takes that naked leg. For those of you who know a little bit about options, or if you want to learn how we do that, you can go back and watch the Tuesday class. He takes that naked leg and he puts it right on top of the call that he bought. So buys the underlying stock, whichever one it is, a single stock. Let's say we're doing Tesla. All right. He goes in, and instead of buying the shares of Tesla, he buys a call option of Tesla. And then he sells, because when you sell, you collect the premium, right? Right at the exact same price. So if he buys it for $1,000, he then sells one for $1,000, and they give him the premium of $1,000 for the premium that he bought for $1,000, and he has what we call a free trade. Very smart strategy. All right. Love bull call spreads with a naked leg. But he takes that naked leg and he scoots it up, puts it right over the top of it. It's called a synthetic long position. All right, synthetic long. And the reason it's called synthetic is because it acts exactly as if he would have purchased the shares themselves, only he didn't purchase the shares. He purchased the shares with options. So he has huge leverage. All right. So then he does the exact same thing as JEPQ. He sells a covered call to collect that premium, but he didn't have to spend $10,000 to buy the shares with his synthetic long. He only had to pay $1,000. So now he gets the leverage of putting in $1,000, makes the same amount of money as if he had put in $10,000, plus he gets the covered call. It's a very, very fancy trick. All right. So then he says, oh, I can do this on a single stock, and I can put this single stock strategy into an ETF, and people who want to join in with me and let me trade for them with this bull call spread with a naked leg, they can give me their money into this fund, into this ETF, and I can trade the options over here on the individual stocks, and we can give a much larger dividend because it's based on options trading as opposed to buying the individual shares where you have the leverage. And it's a really cool idea. Now, this circles back around to what I was saying before, as we have our universal basic income. All right, everybody's concerned that the AI is going to take their jobs, and so I've come in here and I said, hey, look, guys, it's relatively difficult to live off of your dividends, the money that they give you in JEPQ, although a very good dividend, you have to admit, if they're going to give you 62 cents for every share you own, JEPQ is a very nice dividend. But you're going to have quite a bit of money in JEPQ, maybe $1 million in there to make enough money for you to be able to live off just the dividends, okay, to sit there and kick out enough money for you. But if you do it with this other company, with this Jay Petrocelli company, the name of his company is called YieldMax, he does the same thing and he gives you the monthly dividend, but instead of doing it with shares, he does it with options. The dividends are like almost 10 times more money. It's amazing. All right. So let's come over here and we're going to pull up. Let's pull up Tesla just for fun. All right. Everybody loves Tesla. I used to say everybody loves Tesla. I don't know if everybody does love Tesla anymore. So this is Tesla, TSLA. If you're going to go in and you're going to invest in Tesla, you'll notice that Tesla does not give, if I can get it up here, Tesla does not give a dividend. All right. So a dividend is a little blue dot across the bottom. So if you remember when we brought up JEPQ, so that's JEPQ. Notice it has the little dividend circle down here, and that's 62 cents per share, just like we mentioned. So it's $54 as a share, and for every share that you own, they're going to give you 62 cents. That's pretty cool. That's pretty darn cool. And they're just investing your money right into the QQQ. Very stable, very good, very long-term strategy. Has been going on for years. All right, been doing this. Jay Petrocelli comes along only 2 years ago, and he says, we're going to do the same thing, only we're going to do it on individual stocks, so TSLA. And what he does is he comes in and he says, look, I'm going to come in and I'm going to give you dividends on Tesla. Now, Tesla itself does not pay a dividend. All right, no dividends. Those are earnings. Those are not dividends. So there's no little blue circle at the bottom of this chart that gives you the dividend numbers. So what we're doing here is we're now looking at this as Tesla, and you can just buy Tesla just like any other stock, and you can ride it. If it goes up, you make money. If it goes down, you lose money. So what we're going to do is we're going to come in, and Jay Petrocelli says, I'm going to create an ETF, an exchange traded fund, which is based on Tesla alone, and I'm going to trade options on it, not just buy the shares and do covered calls for the dividends. So here we go. It's TSL and Y, because the name of his company is YieldMax. So he's going to come in here, YieldMax, of course. Dividends are the yield that you get, right? And he's got max. He's going to maximize your dividends, is what he's saying, maximize your yield. So the name of his company is YieldMax, and he created an ETF called TSLY. Now it's based on Tesla, TSLA, but he puts the Y on there for YieldMax. It ends up being TSLY. So if you hit TSLY, this is no longer Tesla. It is now the ETF, the exchange traded fund, that trades Tesla, but they give you the dividends based on the amount of money they make trading the options, the bull call spread with the naked leg. All right. Now, one of the differences between Tesla, now Tesla, TSLY, one of the big differences, one of the things they do that is different than, let's say, JEPI, for example, or JEPQ. We're using JEPQ as our example. So if we go back to JEPQ, right? So we go back to JEPQ. What do? Now, JEPQ buys the underlying QQQ, which is the NASDAQ, 100 shares of the largest tech firms, and they just leave that money in there. So if you give JEPQ your money, $10,000, they're going to take that $10,000 and they're going to put it into QQQ for you. And then they're going to sell covered calls against it. And then the way they give you the dividend is from the covered calls. All right. So the covered calls are the dividends. So when they collect dividends from they collect premium from the covered calls. They give it to you as a dividend. But your $10,000 that you've got in the QQQ is still sitting there. Now, you can do this yourself. You don't have to give it to JEPQ to do it for you. You can go out and buy QQQ, put $10,000 into QQQ, and you can sell some covered calls. And every month you're going to have that covered call expire if you do it about a 30-month day, 30-month, and it's going to take that covered call money and it's going to put it into your account, and you're going to get that dividend. Or it's not a dividend at that point, right? It's just a premium from the sale of your covered call, and it's going to give you that money every month, and you can use that as income. You can do it yourself. You don't have to have JEPQ do it. It's just that JEPQ will do it for you, and you give them a little bit of a fee, and they do it for you, and away you go. You're all happy, and you don't have to deal with it. You just give them your money, and they do it for you, and they give you that premium. The difference is that they don't, that your $10,000 stays in the QQQs. So if the QQQ goes up or the QQQ goes down, well, that's great. It's called your net asset value, right? So your net asset value of the Qs will go up and down. With your $10,000 will go up and down with the Qs. But the premium or the dividend that they're giving you comes to you every month, and that's just the premium that they're collecting from selling a covered call. Again, you can do this yourself, but if you don't want to do that yourself, you're like, well, I don't really want to do it. I don't really like the idea of having to watch my portfolio that closely. I don't want to have to sit there and trade it. Who wants to do that? I want to go work at my job, or I want to go travel the world. Whatever you want to do, you don't want to sit there and tend your portfolio. Not that it's hard. You can, once you learn how, it's relatively easy to do, but it's the same thing. You're just turning it over to them and they'll do it for you. All right. And then they give you every month your money. And so the difference here between what Jay Pestrichelli is doing and what JP Morgan is doing is that JP Morgan is not doing anything with your $10,000 you give him other than just throw it into the QQQs. All right. They just throw it in the QQQs and they just give you the premium from the called option. Now, if we go back to what Jay Pestrichelli doing, if we go over here to TSLY, now he's actually trading this aggressively using options. And so when he goes into Tesla, he doesn't just take your $10,000 and buy Tesla with it. He takes your $10,000 and uses it with what we call buying power. Okay, that increases if you come over here into Track and Trade, which is a trading platform. You can see you have buying power right here. Now, in our little account right here, we have $137,000 in our account. And this year we started out with 100,000 and we're up 37,000. That's pretty good return. We're pretty happy with that in this little demo account that's for our class, right? Our class account. So your buying power, if you give him $10,000, his buying power will go up by $10,000, and he can do a synthetic long call position. All right. He can do a synthetic long against a call, that bull call spread with a naked leg. Now he's going to make money on the bull call spread. And he's also going to make money on that sold premium on the synthetic long. He's going to make money on the synthetic long because he's going to buy and he's going to sell, which is free trade. So he's going to get the shares for free, basically, because they're going to pull it from the buying power, which is the money you gave to him. Gets a little bit more complicated in here, but then he's going to do the covered call as well. So not only is he going to make money on the long call as if he owns the shares, he's going to also make money on the covered call. So you get the covered call, that's your dividend, but he also makes money or loses money based on the synthetic long, which is the same exact thing as if he was to buy the shares, but he doesn't buy the shares. So those options will eventually expire, and they'll make a big bunch of money if the market went up, or they'll lose money if the market went down, because it acts exactly as synthetic long, so it acts exactly as if he owns the shares. So it's working the same thing, but then you can get bigger dividends or smaller dividends, depending on whether the market went up or down while he had his synthetic long, but you're still getting the calls. Okay. So what happens is, because he's trading this thing on leverage fully with options and there's no buying of the underlying shares, then when you do the Tesla fund or the TSLY, so if we come in here, TSLY, so this is the Tesla TSLY fund. You put your money in here. What he does is he takes out money every time and gives it to you. So the fund can go down, the fund can go up, just like Tesla, but he's taking money out every month, and he's taking a lot more. All right. So if we come over here and look, we're going to pop back over here, and you can see the TSLY right here. He's giving you 40 cents for every share. And you're like, well, JEPQ gave me more than that. Yes, but JEPQ didn't have $8 shares. All right. So you can do the math. So I think it would be worthwhile to do just a little example of the math. We'll just do one example just to kind of show you. I'm going to grab a little piece of paper here, and we're going to come in and we're going to do a Tesla share. Okay. We're going to do it with $10,000. So this is how you do the math to figure out how much. Is very simple math. You can do it if you went to kindergarten. All right. So whereas kindergarten math, actually not kindergarten. I don't think they teach math in kindergarten. Maybe they do. This is third grade math. All right. If you went to third grade, if you made it to third grade, you can do this. So let's come in here, and we're going to take, let's say $10,000. Just write that down on a piece of paper, $10,000. And you're going to take your little calculator off of your little cell phone. Most of you have these. And we're going to take our little calculator, right? This little thing here. Just that, take that little calculator, and we're going to do this. We're going to take that $10,000. So you take $10,000 and you divide it by the share price of TSLY. Now, there's a lot of these. There's more than just Tesla. There's a bunch of them, and I'll show you what some more are. But this is just Tesla. So we're going to take our $10,000. We're going to divide it by the number of shares. So the shares right now are 832. So we're going to go divided by 8.32. Do they do division in third grade? I don't know. Maybe we have to go to fifth grade. All right, so we hit equals. That equals $1,201, right? So that means we have 1,201 shares. So if we put $10,000 into Tesla, they're going to give us 1,201 shares. So we're going to come in here, write that down, 1,201 shares. And then they're going to give you, in this situation, this is real money. This has really happened. It's not just like something theoretical. This really happened on June 12th. For everybody who had 1,201 shares, they gave them 40 cents per share. So we're going to come in here, going to go 1,201 times 0.40 equals. That was $480. So for everybody who had $10,000 in there on June 12th, they gave you $480. Let's write that down, $480. That's pretty good money, if I do say so myself. All right. So now we're going to come in and we're going to go over and do the same thing and do apples to apples comparison with JEPQ. Now, JEPQ is a really nice fund, and we really like it, and I have nothing against it. And I tell lots of people, if you like this type of thing, maybe you want to put some money in JEPQ as one of your foundational structures, because it's very much more stable than maybe some of these yield max funds, because the yield max funds again are being traded with options strictly, whereas JEPQ still being traded with shares and options combination. All right, so now we're going to come in, we're going to do the same type of math. Let's say $10,000 once again. So we're going to put in 10,000, 1, 2, 3, $10,000, divide it by the number of shares, $54. So 54.03 equals, well, that's easy. 1,000. Oh, let's see. It comes out to be 1,000. Oh, did I do my math wrong? It's 1,000 shares, isn't it? Hold on. No, it's not either. So we're going to do 10,000, 1, 2, 3. Yeah. Divided by, yeah, it's trading at 54. 54 point equals, no, it's 185 shares. So I did have an error. So we got 185 shares of JEPQ with our $10,000. All right. You probably already had that done. So in JEPQ with $10,000, at $54 a share, we can buy 185 shares. All right, not $185, 185 shares. Now, in June, they gave everybody who had their 185 shares, their $10,000 in JEPQ, they gave them 62 cents per share. So if we have 185 shares, $10,000 worth, we're going to go times 0.62 equals. So they gave us $114. All right, that's pretty good. Can't complain about that. Every month, if you have $10,000 in JEPQ, they're going to give you $114 based on that covered call. Now, you have to also take into consideration that you're still have $10,000 invested in the Qs themselves. So if the Qs rise in price, well, that is your net asset value rising in price. So the Qs going up are going to also earn your money, but you're going to also receive these dividends from selling the covered calls. So you're going to have $114 bonus over the top of that. Now, what's the difference between what's going on over in Tesla? Well, first of all, it's only being traded on a single stock. It's not being traded out there on the entire basket of funds of the QQQ. And the other thing is that they're using a synthetic long position rather than owning the shares themselves. So the synthetic long position could make a lot more money because it's leveraged. All right. Now, that's the difference between $480 in Tesla, a single stock, Tesla, a single stock futures, or it's not a futures, a single stock ETF, and JEPQ, which is the QQQs with a covered call strategy. You're going to make $480 in TSLY a month, and you're going to make $114 in JEPQ in a month. All right. So it's a big difference, about 4 times more money over in the single stock futures using this other bull call spread with a naked leg strategy. Now, the difference too is that the JEPQ, remember JEPQ, they're not taking any of the profits out of your $10,000 of the growth of the QQQ, the underlying QQQ. The only thing that's coming out as dividends is how much money they're making on the option itself. Your QQQ money, your $10,000 is still sitting in there growing with the Qs. Now the Qs generally, we can pull up the QQQ in here, and there's a little tool in here that's really cool. We can come in here and we can do a comparison. All right, so that's the Qs. We can come in and we do a comparison, and we can say how big does the QQQ versus the SPY. You can see that right in there. And the QQQ SPY, you can see the difference between the two. They travel almost exactly the same. All right, but over time, the QQQ earned 13% total over the last year, as the SPY earned 12%. All right, now you can also throw in here TSLA, and you can compare Tesla. Now, Tesla might do better, they might do worse. So Tesla has earned 65%. All right. The individual stock Tesla, which is also included in the SPY and in the QQQ, has Tesla in it. So Tesla's in there, but if you just did Tesla by yourself, you can see Tesla is 65% over the same time period as what the SPY made at 12% and the QQQ made at 13%. So that's your diversification, right? You're not having the big, huge rallies and falls that you get in the individual single stocks. You're not having all the volatility, but you have the individual funds that are a little bit more stable, right? More like the, following more of the GDP of the nation. So you get this kind of different look or different view. Now, one of the problems with trading individual stocks is that if you bought right here and the market went all the way up here and you didn't sell it and take your profits, and then it went all the way back down here, well, you didn't make any money. You had the opportunity to make a whole bunch of money because you could have bought it low and sold it high, but you didn't. You bought it low and it went all the way up here, and you held on to it in hopes that it went higher, and then it turned around and went all the way back down here, and you ended up making no money. Now it's turning around and it's going back up again right now, but you missed the opportunity to take advantage of the single stock that rises and falls and has a lot of volatility on it. So if you want to be a trader, what we call a trader, you would trade individual stocks and you would buy low, sell high. If you're not interested in doing that, you want to be an investor, which is somebody who just buys and holds. And if you're going to be an investor, you probably don't want to buy and hold individual stocks. Not that you can't, you certainly can, but usually investors will buy a basket of stocks or more stocks and do what they call create a portfolio, and then they have more of a balanced situation. But there's really no, in this modern day of investing and trading, there's really no purpose in being a trader if you're creating your own basket of stocks, being an investor and going out and saying, I'm going to grab this stock and 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 put it into my portfolio and build your own portfolio. There's really no reason, because that's all done for you at this point with ETFs. Exchange traded funds do that for you, and they're very well tracked and organized and maximized, and they really tune in the very best ETFs to to do that. And some of the best are the ones that are using options to help augment the growth of their underlying stock. So JEPQ and JEPI are very nice ones. And there's a couple of others that are really nice too. And it's beyond the scope of this class. And I'm not going to sit there and go into all these great ETFs for investing, but because we're here to learn more about the yield max funds, which are what I call the universal basic income. And you can see the reason why, because for $10,000, you can either get $114 a month from JEPQ, or you can get $480 a month from the yield max single stock ETF. And I like single stock ETFs. Again, I come from the world where we tried to do single stocks futures, and I loved them so much. So now that we got somebody doing single stock ETFs over here, I kind of gravitated to that. Now let's come over and I'll show you, go back to our trading platform. There are a whole bunch of these single stock ETFs, and you can choose any number of them, and you can build, again, we're going to build our own portfolio, but you don't have to, because YieldMax has already done it. They have some of these individual funds that are where they've taken, like, for example, MAGs. They have a MAGs, which they do the high growth on. So we're going to go in and I'm going to show you, it's called YMAG. So we pull up YMAG, and you can see this is the Magnificent Seven, and this is where they're trading this with the bull call spread synthetic position. All right, bull call spread with a naked leg. And you can trade the YMAG. Now this is the Magnificent Seven, and we're going to go over and we're going to pull up the MAGs, the one that's not traded with options. This is the MAGS, and it is not traded with options. And so you can see it's a little bit more of a growth fund. And the reason why the YMAG, the reason the YMAG hasn't had that big growth is because they're taking the money out, the profits, and they're giving it to you. All right. So remember, when you do something like MAGs, they buy the shares and they just sit on them. Now, MAGs doesn't even do the options. It would be cool if somebody did that. Now, that would be a good idea. It's a little bit of what JEPQ is doing, isn't it? But it's not just on the MAGs. JEPQ is on the QQQ, which is 100 shares. It'd be cool if somebody did a MAGs where you buy the shares and do covered calls against it, which you can do yourself manually. I mean, but it would be cool if somebody was doing it for you. Just a thought there. So you would come in here and we do the MAGs, and then you could come in and sell covered calls against it, and it would be the same process as JEPQ, only it would be just on the Magnificent Seven instead of the full QQQ. That would be an interesting thing. But you don't have to, because you got YMAG, and YMAG will come in here. And what they do, and they don't hold on to, because they're doing options, they don't hold on to any of the money, any of your money, and leave it in the stock and let the stocks grow and have that underlying growth. That's one thing that YMAG doesn't do. YMAG is, and this is why I call it a universal basic income portfolio, because if they're giving you basically 4 times more money, it's because they don't hang on to your $10,000 and let it grow in the stock. What they do is they trade that bull call spread or the naked leg, and when those things expire, they take those profits and they just give them to you. So they're trading options on your behalf, just like JEPQ would be doing, only they're just investing and then doing the covered call. YMAG comes in, and what they do is they're selling the bull call spread with the naked leg, and when that option expires, well, there's either a profit or not a profit, and then you got the covered call, which is either a profit or not a profit. But as they trade these things, markets generally go up. They don't have anything they leave inside the fund. The fund doesn't grow because there's nothing left in there, because they're not buying it. They're not buying Tesla, or they're not buying YMAG. They're trading options on it. So the option has an expiration date, right? When you buy an option, you have to decide how long you want to hold that option for. And so at the end of the option's life, they just give you back all the money that you made, or take it out of your buying power, right, if you lost. But then what JEPQ does, or not JEPQ, what YieldMax does is, because those options, they make the money, well, they don't really belong in Tesla, and they don't just leave them in Tesla. All that money from the covered call and the bull call spread with the naked leg, when they profit out, they just turn around and give it to you. That's how come it's so much bigger, right? That's why when you do your math, you're like, wow, how come they gave me $400 versus $114? The difference is, well, the $480 comes from synthetic long positions, which are basically a free trade. It's the leveraged money, right? So that leveraged money comes into you and they just give you the profit. Now, they don't put it into an account that grows over time. YMAG or Tesla doesn't sit there and grow over time because it's not really Tesla itself. It's the money that's been invested in Tesla. And if we make a lot of money, well, though, you'll see this fund go up, but then they can take the money out and give it to you. And so they're always taking money out of it and giving it to you. And so you're like, well, why doesn't it rise like Tesla? Or why doesn't it rise like YMAG? Well, because they're taking the profits out and giving them to you. And so it is rising like Tesla. In fact, it's rising faster because it's leveraged money. It's just that it doesn't show in the chart because they're taking that money and they give it to you. Okay. So instead of just giving you $114, which would then leave money in the chart and the chart would grow with that extra $300, well, they're not doing that. They're just saying, if you're going to invest in TSLY, it's because we believe that you need universal basic income. You need to use the money that you're making in the stock market to live off of. You're not just trying to grow a big stock. You're not just trying to grow a big nest egg that rises in price and then turns around and falls in price and you end up losing everything. So what YieldMax does is all along that entire uptrend, well, they're giving you profits. They're taking profits along the way. All the way down the trend, well, they're still giving you the money from the covered call, which is making money, but they're losing money. And just like the underlying stock, they're losing money in the underlying stock, but they're still making the covered call. So you're actually losing money in a down market, a bad market. In the YieldMax funds with the options, you're losing money more slowly. Okay. You're losing money more slowly. And so I sat through this. I actually traded this all the way up and all the way down with the YieldMax fund. And it was amazing because the options that they were giving me, the market would drop, but then they would give me these big dividends, and the dividends were covering almost the entire amount of the drop of the stock. So even though the stock was falling and flushing this whole time, I didn't lose any money. Very little, almost nothing. So when we get this little tiny bounce or this little tiny rebound, I was back being profitable again very quickly with the YieldMax fund. But they kept giving me dividends all the way down the downtrend, which was covering the losses as the market would go down, right? The then net asset value was being covered by the dividends. So you lose money more slowly in a leveraged account with options than you do if you were just in the actual underlying Tesla stock itself. If you just bought Tesla right up here and then it went down, you just lost a whole bunch of money because you didn't get any dividends all the way down. You weren't trading with options, so you weren't collecting premium. I believe it's a better way. Now, there's a lot of people who don't like these funds, and that's fine. Well, different strokes for different folks. If you kind of like the idea of the options trading strategy where you use a little bit of money to make a large amount of money, yes, it's a little bit more aggressive. It's not like it's free, but it is, in my opinion, because it's leveraged and because it's protected using a covered call, you have advantages and disadvantages both way. Now, I'm not going to go into the disadvantages of covered calls in this class. It's a little bit beyond the scope, but just to say it caps your profit. So if the market was actually going to explode higher, like up through here, if you own the shares right here of Tesla and the market rose really fast all the way up through that explosive market, well, you would have made more money just holding the shares in TSLA than you would have in TSLY, because the covered call would keep limiting those explosive growths. All right, just capping off those little peaks every month. You wouldn't catch that last little peak every single month, so you'd sacrifice that for the income that it gives you, that big income. And that's the downside of covered calls. And that happens in JEPQ, JEPE, any of these other covered call strategies where it kind of caps that top. The thing is that markets don't explode like that very often. Now, they do sometimes in individual stocks. It's obviously more likely that you're going to get an explosive growth in a stock for maybe a month or two than you are in an index. So if you're going to just do JEPE or JEPQ, you're probably not going to experience that problem because they're not going to explode, and go up 20, 30, 40%, 50, 80, 100% in 1 month, like you might see in a stock, because they're bound by this big diversification. All right, so that's just a quick rundown. Let's run back over, and I'm going to pull up a couple more slides here. I want to just mention to you, I like to use this example. How many of you like the Olympics? You like the Olympics? You guys like Olympics? I like the Olympics. I like to watch them, right? And if you go to the Olympics, I'm going to teach you right now how to be a pole vaulter. All right. I love the Olympics, and I like to watch the pole vaults. I think that's one of the fun things that they do at the Olympics. Now, here's how you become a pole vaulter. You have this thing they call the approach. All right. And you stand there with this big long pole and you start to run really fast. And then you put that pole down. You can see in here, it's called the plant. And you plant that pole in a hole on the ground. And then you kick your legs up and it flips you up over this really tall bar, just like that. That's called the takeoff. All right. And then when you come down, that's called the over the top. And then this is where you land on this soft, big, fluffy thing and you jump over that great big pole. All right. I just taught you how to be a pole vaulter. Now, tomorrow, I want you to go and enter the Olympics and become an Olympic pole vaulter. Do you think you can do it? Why not? I just taught you how. Oh, maybe you need to get in shape. Maybe you need to run a little bit more. Maybe you need to practice. And maybe to get to the level of being in the Olympics, you have to be really good and dedicate yourself really super hard to get there, right? It's not any different than the stock market. I'm going to teach you how to do all this stuff. You come to my classes, can't teach it all to you in one day, obviously, but I'm going to teach you how to do all of this pole vaulting in the stock market. I'm going to teach you how to get into Tesla. I'm going to teach you all kinds of really fun stuff. I'm going to teach you what the differences are between trends, long-term trends and short-term trends. I'm going to teach you passive investing. I'm going to teach you active investing. I'm going to teach you the difference between fast-paced and slow-paced. I'm going to teach you more sophisticated and simpler strategies. I'm going to teach you what it takes, what kind of computer system you might need to be able to trade like this. I'm going to teach you the software that you might need to be able to do it properly, the right kind of pole to do the right pole vaulting, right? The right tool for the right job. I'm going to teach you all this stuff. I've got a manual that can help you teach. Go get my book. It's on Amazon, all right? Search Lan H. Turner. There's a book on this, 280 pages long, of all this stuff that we've talked about and how this is all going to work together, all right? So you can get the book. We got the magazine that you can use. You go get the magazine because that's going to help you become a better pole vaulter in the stock market. All right. It's going to take a little bit of time. I got this YouTube channel. All right. This is here to help you. It's free. You don't have to even pay for it. And I'm going to do it. Now, if you're in the southern Utah, St. George area, you might want to come to the university classes. All right. And you want to come to my classes and we do the academic work there. These YouTube classes, these are just the labs, all right, for the university class. But we're going to work through this. It's going to take something. It's going to require you to learn the trifecta, the technical analysis, the fundamentals, and the technicals, and the investing, and the day trading, and the options, and all that kind of stuff. If you want to be an Olympic trader and make Olympic money, you got to dedicate yourself and you got to learn. I can show you in one class how to do it. And I just did. Go invest in TSLY. Is that going to make you rich, rich, rich beyond your wildest dreams? No, but it's going to give you a good starting point. All right. And if you understand the underlying concepts between what's being done in that fund versus other funds, you're going to see the differences and you're not going to freak out. You're not going to go off to some guy on some other YouTube channel that says, oh, no, don't trade the yield max funds because they're yield traps. That guy doesn't know what he's talking about. And I don't blame him. He's just naive. All right. He just doesn't know. He just doesn't understand. So he's never going to be an Olympic pole vaulter in that sense. All right. He just doesn't understand it. Now, he'll eventually catch on. Like in 2 years, he'll figure it out and then he'll feel stupid. Okay. Or maybe he never will figure it out. Who knows? We don't know what those other guys are doing. You found the right channel. You're here in the right place. We're going to do all this together. You just need to subscribe, come back and join us, and you can be an Olympic pole vaulter in the stock market with us. All right. Now you're saying, well, Lan, show me your Olympic pole vaulting. Let's do that. Let's pull up my real money universal basic income portfolio. And just to give you an idea of what you can do. Now, remember, the yield max funds have only been around for about 2 years. And some of them haven't even been along that long. They've been around 3 or 4 months, and some of them are brand new. So this is my portfolio. I started trading the Yield Max funds in this particular account, and I got like 10 accounts that I trade. All right, I've got my individual account, which is this UBI account. I was trading it with I was doing options, all kinds of really fun stuff in this account, and then I started doing the UBI stuff, the individual universal basic income stuff. And I decided that what I was going to do is I was going to just dedicate this one. Let me just move myself over here. Dedicate myself to just doing the Yield Max funds in this one account. So, and I don't strictly stick to that. Sometimes I trade options in here too with the Yield Max, with the money that I earn from Yield Max. But I've come in, and here are some of the funds that I am investing in the Yield Max funds. Now, I'm going to warn you, I started doing these funds over a year and a half ago, and I kind of get stuck in them. So I'm not recommending that you start your portfolio out with these same funds. All right. But you can see I have YMAG, which is the one we talked about earlier, the Magnificent Seven. And then YMAX has one of their own. Again, like I said, they have one of their own that they kind of take a bundle of a bunch of their own individual ETFs, and they bundle it into one, and that's called YMAX. And you can see the yield on YMAG is 69%. The yield on YMAX is a little bit more. It's 10% more. So that's nice. If you want to choose one, you can choose YMAX. Now, I chose YMAG in the beginning, so I have a larger percentage of money in the YMAG than I do in the YMAX. So you can see my dividends are larger. So you can come down here. Another one that I have is Misty. Now, Misty is a tough one. It's very volatile. I also have Snoy, which is another tough one. It's very volatile because I was into Bitcoin at the time when I started this a year ago, back in July of 2024. I started this. I was doing Bitcoin, right? Bitcoin was all the rave, and we made a whole bunch of money in Bitcoin. So the Yield Max funds have some Bitcoin ETFs, and so I thought, well, I'll put my money in there. So I got kind of stuck in these as well. So I'm in these, and I'm not sad. Misty has 132% yield. That's not bad. You can see that in the month of June, I made $8,000 in the month of June in Misty. That's pretty good money. In the month of May, I made $11,000. Now this is real money. This isn't a demo account. This is tracking my real money portfolio. So this I do with a spreadsheet. And you can have this spreadsheet to track your portfolio. If you subscribe to Pitt News Magazine, you get this portfolio or this spreadsheet to go along with it. That's one of the bonuses that you get when you sign up for Pitt News Magazine. You get this spreadsheet. And there's my April. Misty paid me $6,367 in April. You're like, well, how much money did you have in there? Okay, let's come down here and we find Misty. This is my little section of Misty. And you can see right here, I have in there in 2024, I put $130,000 in Misty. And then I added on 12/20 another 10,000. On 3/3, I added another 18,000. And then on 5/20, 15,000, and 6/25, 6,900. That was yesterday. I put in another $7,000 into Misty. And so this is how much money I've invested in Misty, which you can see down here is a total infusion of $182,000. So is that right? 30, 40, 50, 60, 70, 80. Ooh, I got a lot of money in Misty. $182,000 in Misty to get that $8,000. So $182,000. Well, it's not like I have to have, to make $8,000 a month. I don't have to have $1 million like many accounts, right? So $182,000 in Misty alone, and that's what's given me that $7,939 a month. Or last month, they had a very good month, so I had $11,000. And I remember they're trading it with options, the synthetic longs, the bull call spread with the naked leg. So they're going to have good months and bad months, depending on whether the market rises or falls. And last month, Misty had a good month, so I got $11,000 in 1 month off of that $182,000. And then they gave me $7,900 this month. So this month, you can see off of my universal basic portfolio, you can see over here, just in Misty alone, these are all of my dividends, clear back going back into 2024, 6,000, 10,000, 8,000, 7,000, 6,000, 6,000, 11,000, 7,900. So you can see, and then I have what I call a cash cow, which means it's paid for itself. So I've got enough dividends to cover the cost. And then that's what this parity is. So it says I'm $470 shy of having enough dividends to pay for all the money I've put in. So I've received back enough money to cover everything I've put in. I'm shy $400, but that's just because I just put $7,000 in. My parity was positive. So this one here you can see is Palantir. I'm positive parity by $43,000, which means I could probably invest some more in Palantir and keep my parity still positive. I like to keep a positive parity. It doesn't have to be. It just pushes out how long it's going to take to give you all of your money back, right? Become break even. That's what I call a cash cow. So this up here, this 4.85 means in 4 months, 4.85 months. So in basically 5 months, I will have my entire portfolio will be what I call a cash cow, meaning that the dividends have completely paid me back enough money to cover the initial investment, which is over here of $476,000. So I put in $476,000 in 5 more months, I will have a cash cow, meaning that the entire portfolio, all of the dividends will have paid me back $476,000 and I'll be at parity. That's what I call parity, at break even. So I have covered all my costs. I have no more out-of-pocket costs. Now, the problem with me is I go and I take all that money that they've given me, I just put it right back into the market. Now, I have taken some out. I've taken $93,000 out and gone and spent it and bought things with it, okay? So I have pulled $93,000 out of the account. That's what that number there is. But my UBI account ROI, return on investment, is 60%. Right now it's sitting at 60%. That's pretty good return on your money. It's better than you're going to get in the S&P 500, which averages 10%. All right. So by doing it this way, building my own portfolio out of the Yield Max funds, I'm getting so far a 60% return. It's a little bit better than the S&P 500, which is 10%. All right. Now, my total amount of profit is sitting right here. Total profit that I've made is $284,465.56 as of right now, as of today. Now, this number here, 13. Now, what I do is I told you I keep taking my dividends, and instead of just taking them and putting them in my bank account at home, I put them back into the market. I put them back into the Yield Max funds. Now, I don't drip, and I'd recommend if you're going to do this, don't ever drip. Don't ever just take your dividends and put them right back into the same fund. That's not a good idea. You want to be strategic about your re-entries, and we go into that too. That's something I'm going to teach you in these classes, how to get your money back into the market strategically so you're not just doing this stupid drip idea. Don't ever drip. All right. The worst thing you can ever do is to drip your money back into the market on dividends. So don't ever do that. If you're doing that right now, immediately go. First thing you're going to do after this class is over is turn that feature off. Don't do that. All right. So what we're going to do is we're going to come in here and you're going to see the 13. So that means 13 months versus 4 months. So to become a cash cow is 4 months. That means in 4 months, 5 months, basically 4.85 months, I will have made enough dividends. And that's a projection. It's not exact. It's just a projection based on my averages. So I will have received $476,000 in dividends. Now, again, remember, I said I took most of those dividends and put them back into the market. So what that does is that pushes my cash cow out. And I don't call that one a cash cow. Now that one's called a gravy train. All right. So once my total infusion, my initial deposit, you can see cash cow is an initial deposit, and my gravy train is total infusion. So the total amount of money that I put back into the market will be back, and I'll have a full break even, and I'll be on what I call the gravy train, where not only have I made back my initial deposit, I've also made back enough money to cover all the money that I put in, all the blended money. And that will take me 13 months. So in basically 14 months, if I just keep things going the same as they are, don't keep putting more money in, but the problem is I'll take more money and just keep putting it back in. Every time I put more money back in, it'll push this number out right here farther. All right, it'll keep pushing that number out farther and farther and farther. And if I take money out and don't put it back in, it'll push that number out farther and farther and farther. All right, so and that's okay. You're meant to live off of this type of an income. That's why I call it a UBI, universal basic income. It's meant to give you an income every month. You don't have to put it back in. I only put it back in because I don't need it. I'm making so much money, I don't need it all. I don't know what to do with all the money I've got. So I just put it back in the market. And what does that do? It grows and makes me even more money. I just don't know what to do with all the money I got. All right. I'm a simple guy. I can't spend $285,000 a year. I don't have a need for that kind of money. So what do? I just keep putting it back in. I just keep putting it back in. I just keep putting it back in. And it just keeps getting bigger and bigger and bigger and snowballs and snowballs and snowballs. I guess that's a pretty good problem to have. All right, guys. And that's what I'm here to do. Help you create yourself a snowball that will continue to snowball and snowball and snowball for you. And that's the name of the game, right? Have a better life for yourself. And I'm here to help you make that happen. If you want to join, just go ahead and subscribe and come and join me down in Utah Tech University. Now, there's guys that fly in from around the country. I've had several guys fly in, not a lot, but a few guys have flown in or come in, drove in from other parts of the country, stayed in an Airbnb just so they can come and attend my classes. That's something you can do too. So come and do that. I'm not teaching classes again until the fall, but think about it. It might be fun, something fun to do. Give you something. You can come and see Zion's Park and, Snow Canyon, all kinds of really fun, beautiful places down there in southern Utah, the Red Rocks, and then come and have a little class and write it off on your taxes as a tax deduction. There you go. Always thinking about ways to save your money. Okay, guys, that's all I got for you today. I'm going to give you just real quick here a couple little...
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. And then, of course, if you want this spreadsheet, the way you get it again, so you can start building out your portfolio like this, you get it when you subscribe to Pitt News Magazine. And I already told you about where you can get Pitt News Magazine. You just go to pittnews.com and sign up. And then, of course, we also, Claire is one of our writers, and she's got a raise. I don't know if you guys knew, but we gave Claire a raise. She now works for the magazine, and she's the assistant editor. I'm the editor-in-chief. She's the assistant editor. So she's my assistant, and she helps out with the magazine as well as writing articles. She used to just write articles. Now she works for the magazine, and she does her own podcast. We gave her own podcast, so now she does Pitt News on Air, and hopefully you'll subscribe to that too. It's free. I'm going to let Claire tell you about her podcast.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air, because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right. So you can get the Pitt News Magazine. You can get the Pitt News Podcast. You can come to these classes. Most everything, the only thing we're asking you to pay for is the Pitt News Magazine. No, it's only $39. And you can have a portfolio like this. And I'm going to teach you how to be in the Olympics, be an Olympic pole vaulter in the stock market. And you too can have the problem that I have where I make more money and I know what to do with it. So I just keep putting it back into the market again. All right. That's not a bad problem to have. All right, guys, we're going to see you next Tuesday at 8 o'clock in the morning, 8 a.m., and we'll continue the conversation and help you make this happen for yourself. All right. Take care. See you then.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.